Have you ever nailed a setup on paper only to watch it implode because you felt like holding longer? Ask yourself, has that happened to you this month? You're not alone. 90% of retail traders destroy their accounts within the first year. Not from bad markets, from their own brains. Here's the contrarian bomb: your instincts are sabotaging you. Discretionary trading, it's a psychological minefield where one revenge trade erases years of edge. Think about it. Your gut craves excitement, chases dopamine hits from 3% quick scalps, ignores stops when fear kicks in on a 2% pullback. I've seen sharp traders, guys with Ivy League MBAs, reduced to broke in months because they trusted feel over rules. But here's where it gets interesting. But you can flip this. Stick with me, and I'll unpack the hidden psych traps killing your profits, and reveal how mechanical systems autopilot consistency, turning survival into 20% plus annual returns on SPY breakouts. I've coached traders from 10K demo accounts to 7-figure books using this exact shift. I'll share John's blow-up story later to prove it. Your edge dies without discipline. One bad call, gone. But mechanical rules, they don't flinch. Here's what nobody tells you. The data proves it. Van Varp's research on 5,000 accounts shows it. Coming up next. So let's break it down right now. What's discretionary trading versus mechanical systems? Discretionary means you're the boss, spotting setups on your charts, deciding entries based on gut feel at 1.0850 on Euro USD, tweaking stops when the market wiggles 1%, and exiting when it just feels right. You're chasing that perfect read, right? Ask yourself, does that sound like your last losing trade? Mechanical, it's your unbreakable rulebook. Predefined entries like buy SPY only if RSI dips below 30 and price closes above the 20-day EMA at $450. Fixed exits at 2R profit. Risk per trade, capped at 1% of your account, no exceptions, no debates, no overrides. But that dopamine junkie in your brain fights back. Here's the thing, your brain isn't built for this game. Discretionary trading turns you into a dopamine junkie, overriding logic for thrills. And the stakes, brutal. Van Varp's research shows 90% of retail traders wipe out in year one, not from bad strategies, but psych leaks like FOMO on Tesla breakouts and revenge trades after a 3% stop out. Even pros struggle. 80% of hedge funds underperform the S&P over 10 years per S&P Dow Jones indices because discretion amplifies overconfidence. Your one bad call, it nukes months of wins. Think you're different? Let me paint the picture. You're that beginner trader, 5K account, staring at a breakout in Tesla at $250. Chart screams go. You buy, heart pounding. Price pulls back 2% to $245. Your stop says sell. But FOMO whispers, hold, it's just noise. You double down. Boom, 10% drawdown to $4,500. Sound familiar? We all start there. Pumped on potential, crushed by our wiring. But here's where it gets interesting. These traps have names, and I'll break them down next. Common myths kill you faster. Experience fixes psych issues? Nope. It breeds overconfidence, per studies from the Journal of Finance on 10,000 day traders. Seasoned traders override rules 40% more, chasing edge that vanished. Markets evolve too fast for rigid rules. Walk-forward testing crushes that. Backtest on 2010-2015 SPY data. Validate on 2016-2020. Rules adapt without your ego meddling. Survival trumps smarts every time. Psychology beats strategy. Your setup's flawless on paper. Without mechanical guardrails, it's a house of cards in a hurricane. Instinct leads to ruin. Rules lead to riches. But first, the traps, and one trader's nightmare that changes everything. Later, you'll meet John, the ex-Wall Street guy who lost $250K chasing instincts. Stick around, his story changes everything, tying right back to that Tesla pullback you nodded at. Here's the thing, your brain is wired to sabotage you in the markets. Let's dive into the traps that turn smart traders into statistics. First up, overconfidence bias. You've had a few wins on Nvidia calls, adrenaline surges. Kahneman and Tversky nailed it in their prospect theory work. After successes, you start overriding your own edges. Think about it. Your system says risk 1% per trade, but you're up 20% this month. So you load up 5% on that sure thing in Nvidia at $120. Price gaps down overnight to $115. Poof, half your gains evaporate. You're nodding, aren't you? We've all been there, feeling invincible until reality bites. Ask yourself, when's the last time you scaled up after a streak? Then there's revenge trading, or tilt as poker pros call it. One loss hits, not just any loss, a stop that triggered right before a reversal on GBP USD. Rage bubbles, screw the rules, you think. You double down on the next setup at 1.30, chasing that payback. Let me tell you, this spirals fast. Studies from the Journal of Behavioral Finance show tilted traders lose 3x more in the following session. Your 10K account, that 2% loss becomes 6%, then 12% as you chase. Heart racing, screen blurring. You're not trading anymore. You're gambling with fury. Confirmation bias sneaks in next. You're bullish on Bitcoin at 60K. Every candlestick confirms your view. The wicks are just noise, right? You ignore the bearish divergence screaming from the RSI at 75. Psych research from Nickerson's 1998 paper proves it. We cherry-pick data to fit beliefs. Your journal, filled with wins that match your story, skips the losers. Over time, your edge erodes because you're blind to the full picture. Don't forget recency bias, the hot streak illusion. Crypto pumps 50% in a week to 90K. Everyone's buzzing. You pile in, forgetting base rates. 70% of altcoin rallies fade within 30 days, per Chainalysis data on 500 coins. Your recent wins feel like the new normal, but markets regress. You're left holding the bag when it dumps to 70K. Picture yourself as that struggling beginner. 8K account, day 3 of live trading. Euro USD looks perfect. Your gut says buy at 1.0850. No stop, it's strong. Price reverses. You watch it drop to 1.0780, down 5% of your stack to $7,600. Sweat drips. Just a blip. But it's not. That's your account weeping from ignored rules. Here's what nobody tells you. These aren't flaws. They're survival instincts gone haywire in zero-sum trading. Empathy time. I get it. You're fighting for financial freedom. But tension builds when you realize discretionary trading amplifies every leak. It's like driving blindfolded on a racetrack, swerving on hunches while semis barrel by. What if one trader's nightmare proves mechanical rules save you? Stick around, John's story hits next, and it'll make you rethink everything. Let me tell you about John Doe, a prop trader I knew back in the day. Started with 50K in his account, grinding Forex like you might be now. Disciplined at first. Nailed it. 1% risk per trade on EUR USD pairs. He scaled that to 200K in 18 months. You picture it. Steady wins, journal packed with setups, coffee-fueled screens glowing green. Here's the thing. John was you, crushing it on rules, just like we talked about earlier. But then discretion crept in. 2008 crash hits. Markets freak. Lehman melts down. VIX spikes to 80. John scanning momentum plays. SPY's ripping higher on a dead cat bounce from 110 to 125. His gut screams. This is it. The big one. Stats? Ignore them. Base rates show 70% of day traders quit within year 1, per Barbara Anodian's study on 66,000 accounts. But not John. He feels invincible. Think about it. You're in his chair, heart pounding. That hot streak whispers, bend the rules. He ups risk to 10x normal. 20K on one SPY trade. No mechanical stop. I'll manage it manually. Price gaps down 5% to 118. He freezes. Averages down. Adds more. Greed morphs to fear. By close, 100K vaporized. Account, 0. John calls it quits. Joins the 70% graveyard. Tension peaks, right? Your stomach drops because you've been there. Maybe not 100K, but that 5% wipeout on EUR USD. But here's where it gets interesting. What if rules had saved him? Here's what nobody tells you. John's nightmare isn't bad luck. It's psychology unplugged. Discretionary trading, it invites emotional discipline to crumble. Greed says, one more. Fear screams, hold the loser. Rule of 3 leaks, overtrading after wins, revenge sizing post stops, hope paralysis on drawdowns. Contrast that with pros. They don't trust hunches. Ever. Picture the hypothetical. You're John 2.0. Same setup. But mechanical system kicks in. Code says, risk 1%, stop at 118 on SPY, out at 130. No choice. You execute. Miss the moonshot? Fine. Survival first. John's blown-up arc proves it. Consistency over heroics. Psychology beats strategy when you automate the beast. I'll share how later. Empathy check. I get your struggle. Staring at charts, dreaming big. But is pain common as dirt? 70% quit because discretion amplifies leaks. Here's the counterintuitive twist. Mechanical systems don't kill excitement. They forge unbreakable discipline. John's rock bottom opened his eyes, but yours doesn't have to. Recap. Discretionary erodes your edge through bias and blowups, like John's 100K loss. You won't if you flip the script. Coming up, how mechanical systems enforce that discipline you crave. Stick around. You'll see John's what if become your edge, with Sarah's proof. You just recap John's blowup. Discretionary trading's emotional trap, echoing those revenge trades we covered. But here's the thing. Mechanical systems, they lock in the discipline you crave. No more second guessing. Back test them ruthlessly on 20 years of SPY data, then execute like a robot. Think 200-day moving average crossover on SPY at $440. Buy when price slices above. Risk exactly 1% per trade. Stop loss at the 20-day low of $435. Simple, brutal, profitable. Ask yourself, could you stick to that without tweaking? Let me tell you about Sarah, the consistent professional you'll envy. She's no rock star trader. Started with your 10K account 5 years back, fed up with hunches wiping her out on crypto. Built a mean reversion system. Enter shorts on stocks up 5% daily above their 10-day high, like AMD at $150, but only if RSI screams overbought at 80. Position size, Kelly criterion, math that maxes your edge without roulette spins. Kelly says, bet 2% if your win rate's 55% with 1.5 reward risk on NASDAQ names. She coded it in Python, paper traded 6 months, went live. Result, turned 10,000 into 500,000. Not moonshots, compounding survival. Her system lost 60% of trades. Yeah, you read that right. Counterintuitive bombshell. The best mechanical setups bleed more than they win, but winners, 2.5 times bigger at 3R. Math crushes emotion every time. No FOMO adding to losers. No greed scaling winners forever. You hit enter, walk away. Psychology, automated. Here's what nobody tells you. Boring equals bank. Discretionary traders chase heroics. Your one big win fantasy on Tesla. Mechanical forces consistency. Risk management's baked in. 1% caps you pain. Position sizing via Kelly prevents overbetting. You're surviving drawdowns that bury John's. Compounding kicks in. 20% annual edge. 5 years. Your 10K's pushing 6 figures. Tension from John's story, gone. Hope surges because this is your playbook. Think about it. You've stared at charts, heart racing, overriding stops like in that ERUSD example. Mechanical says no. It enforces emotional discipline you lack alone. Recap. Rules like MA crossovers plus Kelly sizing deliver no emotion execution. Sarah's 50x growth proves survival enables success. Psychology beats strategy when systematized. But do they work in real markets? Think mechanical is rigid? History's turtles will blow your mind. Next, stick with me. Your edge sharpens now, crushing those backtest doubts. Skeptical about mechanical systems in the wild? Let me take you back to 1983. Two trading legends, Richard Dennis and William Eckhart, bet everything on a wild idea. Dennis swore anyone could learn to trade with simple rules. Eckhart, he thought it took innate genius. So Dennis ran the ultimate experiment. He scoured ads, picked 23 total novices, no Wall Street hotshots, just everyday folks like you might have been back then. Trained them for 2 weeks on mechanical breakout systems, Donchian channels, buy 20-day highs on crude at $30, sell 10-day lows, risk capped at 2% per trade via ATR, no discretion, follow the rules or you're out. These turtles exploded. From 1984 to 1988, they turned millions into over 100 million. Jerry Parker, one standout turtle, averaged 80% annualized returns on commodities. That's not luck. It's math enforced by ironclad rules. Position sizing via volatility, ATR based at 2%, so you never overbet in chop. They rode trends like freight trains, sugar up 200% in 85, crude oil crashing 86 from 28 to 10. Losses, sure, 40% drawdowns, but survivors compounded. Think about it. Your emotional brain would have bailed at the first dip, just like John. Turtles walked away, trusted the system. Contrast that with Jesse Livermore, the discretionary king, reminiscences of a stock operator hero. Made $100 million in 1929, then blew it all by 1934. Why? FOMO on cotton at 12 cents, overriding his stops, scaling into losers. Your story, same trap. Heart pounding, you chase the breakout, ignore the 2% rule. Livermore died broke. Turtles, retired rich. Here's the counterintuitive bomb. These rigid rules crushed markets because markets are chaos. Your gut, bias toward recency. Last week's Bitcoin winner blinds you. Mechanical, blind execution. Ed Seykota, trend-following godfather, took 250,000 to 15 million over 12 years with similar systems on futures. Walked clients through 70% drawdowns. Systems work because they don't feel. You're nodding, right? Sarah's story, now turtles. Social proof stacks up, building on those psych traps from earlier. Consistency over heroics. No heroics means survival. Survival means compounding your edge. That 20% annual, your portfolio doubles every 3.5 years. Boring? Yeah. Bankable? Absolutely. But you're thinking, backtests lie, curve fits city. Hold that thought. Skeptical about real market proof? Here's how pros crush those doubts with data you can't ignore. Your long-term edge awaits. You're skeptical about backtests, aren't you? Calling them curve-fit fantasies that shatter in live markets. Fair point. Your $50,000 account got wrecked, chasing optimized RSI signals that bombed on live gold. But here's how pros like the turtles demolished that doubt. Walk-forward optimization. They tested rules on 1970 to 1980 commodity data, then applied them forward to 1981 to 1984 unseen markets. Boom, same 30% edge held. Your holy grail? Retrain every few years on fresh data, no peaking. Ed Seykota did it religiously. His system surfed the 80s bull without a hitch. Think markets evolve too fast for rigid rules? Wrong. Edges are probabilistic, not crystal balls. That 55% win rate from turtles, it didn't need perfection. It compounded because losers were tiny at 1R. Winners rode trends to 5R. Nuance, your gut chases it, turning 1R wins into 0.5R scratches from fear. Mechanical skips the noise. Remember LTCM in '98? Nobel geniuses with nuanced models, 4.6 billion blow-up when Russia defaulted on bonds. Their discretion amplified black swans. Your mechanical breakout filter caps pain at 2% per trade, survives the storm. And yeah, you're thinking building this sounds brutal. Coding, data, tweaks. Let me tell you about Mark, the blown-up day trader I mentored. Guy in his 30s, ex-Wall Street, lost $200,000 discretionary trading NASDAQ bubbles in 2000. Chased phantom breakouts on QQQ at $80, ignored stops, FOMO scaled into losers. Heartbroken, staring at margin calls, we stripped it bare. One simple rule, buy 20-day highs on SPY, above 200-day MA at 440, exit at 10-day low or 4R profit of 20. No indicators, no fluff. Back-tested on 20 years data. 12% CAGR, 35% drawdown max. Live, marked paper traded 6 months, flicked to real money. 2 years in, 150K to 320K. No heroics, just execution. See the pattern? Objections crumble under survival math, just like Sarah's compounding. Markets evolve, optimize forward. Too rigid, probability crushes perfectionism. Hard to build? Start stupid simple. Your kitchen table, free Yahoo data, Excel. Mark did it weekends, you can too. Here's the thing nobody tells you. Mechanical isn't anti-nuance, it's psychology proof. Your brain wires for recency bias. Overfits, last month's QQQ winners. Systems, blind obedience. Counterintuitive, right? The less you think, the more you win. All this crushes your doubts, builds unbreakable trust. Relief washing over you yet? Good, because the crucial insight tying psych, risk, and your edge comes next. Stick with me. Your system's foundation starts here. What if risk management was the real psych hack? What if risk management was the real psych hack? You're nodding, aren't you? Because here's the truth. Your mechanical system isn't about flashy entries. It's your unbreakable shield, echoing those 1% rules from the turtles. Think about it. Discretionary traders blow up chasing 10% home runs on Bitcoin, risking 5%, 10% on sure things. You cap it at 1 to 2% per trade, period. No exceptions. Your brain screams, scale up on winners. But that FOMO whisper, it's the devil. Mechanical enforces discipline. Your position size auto-adjusts to volatility via ATR at 14 on SPY, never more than 1% account risk. Survival first, profits second. Ask yourself, what's your current risk per trade? Let me prove it with math you'll feel in your gut. Say your edge nets 20% winners, realistic for a solid SPY breakout system. At 1% risk, that's 0.2% average gain per trade. Over 100 trades a year, compounding hits 25-30% annual returns. Smooth ride, no heart attacks. Discretionary, same edge, but 5% risks on losers. Volatility explodes. Drawdowns hit 40%. Psych crumbles. You quit. Here's the counterintuitive insight. Tiny risks compound to millions. Paul Tudor Jones swore by 1% max on cotton trends. Larry Williams doubled his money in a mechanical World Cup contest, risking 0.5% per trade on S&P futures. No discretion, just rules. Picture Sarah, the struggling beginner I coached last year, part-time nurse, 50K account, discretionary hell, revenge traded Bitcoin pumps from 50K to 60K, down 60% in months to 20K, emotional wreckage. We built her system, SPY 20-day breakout above 450, 1.5% risk via ATR stops at 445, 2-to-1 reward to 465. Journal every trade, not for tweaks, for psych audit. Did I follow? Yes, green light. No, back to sim. 6 months paper, then live. Today, up 28% to 64K, sleeping like a baby. Empathy hits home, right? You've been her. Tension building, failure stacking. But this, hope surges. You're empowered now. Journaling isn't busy work. It's your psych firewall. Log the trade, system signals like RSI 28, outcome. Review weekly, where do emotions creep. But entries, exits, system owns it. No overrides. This crushes overtrading, tilts odds your way. This is crucial. Now, everything connects. Risk psych, your edge, consistency, it's all one machine. From John's traps to Sarah's wins. Tension peaks here. What if one tweak turns your system into a wealth engine? Hang tight. The climax reveals how pros scale this without burnout. Your transformation starts now. Here's the thing. Everything you've battled so far snaps into focus right now. Those mental traps from day one, the blow-ups in John's story, the unbreakable rules from Sarah and Turtles, proof from pros like Seikota, rebuttals crushed, it all funnels here. Discretionary trading doesn't just test your psyche, it amplifies every bias until you're roadkill. Mechanical systems, they're your unbreakable firewall. Survival first, then success explodes. Think about it. You're not fighting yourself anymore. The machine does the heavy lifting. Counterintuitive as hell, right? The real pro isn't the gut-feeling wizard staring at charts till 2 a.m. It's the rule-following robot that grinds 1% edges into fortunes while you sip coffee. Discretion whispers, you got this. One more trade. Boom. Biases hijack. Drawdowns devour your account. Mechanical, signals fire, you execute. No second guessing. Your psych weakness turned into titanium strength. Remember John, the blown-up trader I mentored? Ex-Wall Street hotshot, 200K vaporized on sure thing Forex hunches at 1.30 on GBP JPY. Revenge trades, FOMO exits, down 70% in a year. Tension crushed him. We stripped it bare, built a mechanical crude oil mean reversion system. 50-day Bollinger Bands at $75 middle, 0.75% risk on ATR stops at $72. Pyramid only on winners to $82. Journaled religiously. 6 months sim, 22% return, max drawdown 8%. Live, year 1. 31% net, sleeping through oil shocks to $60. John's words, it's like autopilot freed my brain. Empathy to hope, now satisfaction hits you too. Picture you switching tomorrow. 100K account, your SPY breakout system from Sarah's playbook, above $450. Discretionary volatility, gone. Compound at 1.5% risk. Year 1, 28K profit to 128K. Year 5, over 250K. Drawdowns under 12%. That's the aha. Psych doesn't beat strategy. Mechanical psych beats everything. You've connected the dots. Traps conquered. Failures flipped. Rules locked from turtles to mark. Your transformation? Locked in. Survival enables the millions. Hang on. You've got the map. Now the exact steps to deploy your machine and scale without burnout. So here's the bottom line, you. Mechanical systems crush discretionary trading because they forge psych-proof consistency. Your biases can't touch them. You've seen it with John, felt it in your 100K SPY sim. No more revenge spirals or FOMO fog, just rules that compound your edge, while you live your life. This week, audit your rules. Paper trade one simple system. Say that 20-day EMA crossover on QQQ above 450 with 1% risk. Track it ruthlessly. Watch discretion die, profits stack. Grab my free psych checklist at the link below. It's your autopilot switch, turning gut instincts into unbreakable code. Think about it. Your instincts don't make pros, systems do. Trade smart, not hard.